My name is Tyler Hay, and on behalf of Evergreen GovCal, I'd like to welcome you to our 2013 Annual Outlook event. Before we get started, I was going to ask the Evergreen team members who are here tonight to stand up. It's a little dark, so I can't introduce them. There we go. David Hay, Jeff Uhlberg, Bob Hanna, Steve Dunn, Mike Wiseman, Elena Howell, David Meyer, Rob Daynard, Jeff Dix. If I missed you, raise your hand. Oh, Wyatt Hay, yep. Okay, I think I got everyone. Before we get started, I want to say to the team at Evergreen that helped pull off this event, thank you very much, particularly Jeff Rizzori and Lindsay Hall. I know there's a lot of work that goes into that, and I'd like to say thanks. Also, I'd like to express particular gratitude tonight to our clients who are here. Managing your wealth is a duty in which we take immeasurable pride and responsibility. To the others of you out there who aren't clients, we've been watching your drinks and we'll be mailing you an invoice. Given what I've seen, there could be some pretty hefty invoices. Seriously, tonight's a special night. We're honored to be joined by Grant Williams. I'm going to go out on a limb and say that Grant gets the award for the longest commute. He's traveled 8,000 miles from Singapore to join us. Grant is a portfolio strategist at Volpez Investment Management. Grant also authors a newsletter that many of you read called Things That Make You Go, Thanks for making me say that, Grant. He has over 500,000 readers. Grant's become an important voice and a good friend at Evergreen Capital. If you wouldn't mind, I'd like us all to give him a round of applause. I'm also joined tonight by David Hay, Evergreen GovCal's Chief Investment Officer. He's going to review our 2012 forecast and go over our outlook for 2013. Evergreen's very own Jeff Uhlberg is also here tonight. He's also our Director of Wealth Management. He's here much to the chagrin of his wife, as he's the proud new father of a baby girl. Congratulations, Jeffrey. I convinced him that taking rapid-fire investment questions from the audience, though unpleasant, would still be a welcome break from smelly diapers. Now that he's seen how many of you showed up, I think he's having second thoughts. Jeff, myself, Grant will also be answering questions in a little bit of a change-up in format tonight after some brief remarks by Dave and Grant. The panel format, the reason we decided to do this is because the panel format really represents the way that we make investment decisions at Evergreen. We're fortunate to have resources like Grant, his firm, our partners in Hong Kong, GovCal, and others around the globe, who we gain keen insights and good investment ideas from. We aren't so naive at Evergreen to think that we have a monopoly on the good investment ideas. And we're pretty sure that our clients aren't focused on the origin of the investment idea so long as it meets one criteria, makes them money. The insatiable quest for knowledge and improvement that resonates within our firm starts with our CIO. So without further ado, David.
Thank you very much, everybody, for being here tonight. And it was really fun to be able to circulate. I met most of you, but if I didn't meet you, please don't hesitate to come up afterwards and say hello. Well, I want to take you back 80 years ago to probably the #1 celebrity of that time. He was certainly America's best-loved humorist. Any ideas who that might have been 80 years ago? Will Rogers. You got it. You guys are very good. And he was known for his incredible humor, but he would frequently say, I don't make jokes. I don't make jokes. I just watch the government and report the facts. Imagine if Will was around today, what he'd be saying about our present leaders. In fact, I thought one of the things that happened here recently, I mean, you didn't even need Will Rogers to say this was a joke. You know what happened with this whole thing when the debt ceiling came up, and there were leading government officials that were advocating minting a $1 trillion coin as a way to, I mean, really, I thought when I first heard it, that's a joke. No joke. Imagine what Will Rogers would also have to say about another branch of the government, the Federal Reserve, which actually has decided to go ahead with the whole idea of the trillion-dollar creation of, oh, we should have done this earlier. There's Will. Hi, Will. How about this one? The trillion-dollar bill with, of course, Dr. Ben Bernanke, in Ben We Trust. This is, you know, while it is kind of funny, it's also kind of sad. Just like the whole idea of minting a trillion-dollar coin to try to get around the debt ceiling. I mean, some of these things are, you know, they're fun to laugh at. I guess we have to do that to keep our sanity. But it really is shocking. And I think what's also shocking to me is how much faith the financial markets put in Mr. Ben Bernanke in his trillion-dollar-a-year program. So that's going to be a recurring theme throughout tonight, and actually relates to our forecasts. We like to be very candid about how we performed the prior year. And frankly, even though our overall score was quite good, as you'll see, this one is very embarrassing because really, people care mostly about the stock market. Everything else is kind of way down the list. And really, for the first time in many years, we actually got this one wrong. Because I did think, as many of you remember from last year, that the stock market was going to lose a little bit of money last year, and that's obviously not what happened. So that was a big miss. But we hit it right on bonds, hit it right on the economy, hit it right on housing, hit it right on the Fed, unfortunately, the print-a-thon that they're involved in right now. Higher risk investments, we were kind of hit and miss there. But inflation, we got that one right. The yen is a big one for many of you in here because we made very good money with our anti-yen bet. And it wasn't easy at first. We kind of struggled with that one for a year or two, and then it really cashed in here this year and into this year, as a matter of fact, last year into this year. U.S. fiscal policies, we were pretty skeptical that anything really concrete or really beneficial would happen, and unfortunately that turned out to be true. And we also were kind of hit and miss on the European crisis, though I think we scored ourselves a little tough there. Overall, we got about 80% of them right. Now, to be fair, I also threw out a bonus prediction last year that was another big whiff, that 2012 would be the year that REITs lagged, that we'd have a REIT retreat, and instead they had another very good year. But we'll go over some of these things in a little bit more detail, but I just want to give you the quick scoring. And what did I really do wrong with stocks? Well, it really relates back to what we were talking about with Mr. Bernanke, not having enough trust in Dr. Ben. What we were really focused on a year ago was we felt the economy was going to be dramatically decelerating. If you recall, a year ago, there was a lot of enthusiasm that the economy was in an escape velocity mode, as they say, finally breaking out of the funk after the Great Recession. But that was not the case. We called that correctly, but nevertheless, stocks went up. And I really do think that we were pretty right about what happened to corporate America as well, because we were saying that we also thought, related to the economy, sales would roll over, earnings would roll over, and that's definitely what happened. Usually, when you have this as a backdrop, stocks don't do great. They might hang in there, but usually they struggle. Obviously not the case, and this is why. It's not just the Fed. It's all around the world. Central banks are in the hyper-print mode. And Grant's going to talk about this a fair amount, but I mean, if you look at this and understand this chart, I'm going to just digress for a moment to point out that what this is showing is back in May of 2007, there was only $5 trillion of total central bank assets. Now there's 14 trillion, actually it's closer to 15 trillion now. So basically $10 trillion has been manufactured by the central banks, and a lot of it in the last few years. And that's definitely propping up the financial markets. It's what we call the Great Levitation. But I think the big question is, and we just have to be realistic about this, is what happens when they reverse course. We'll talk about that when we get to the 2013 outlook. As far as REITs, I already admitted we blew that one. It's been wrong to be negative, but for those of you that have been with us for a while, we did close them out largely in 2011 for good gains, but we were premature in getting back in. Fiscal policies, we certainly were right. And again, a year ago, there weren't many folks out there in our business saying, we think the economy is going to be sluggish enough that the Fed will do a QE3. That was a very non-consensus view, but it certainly happened, and frankly, it happened to a greater degree than we thought. We're also right about Europe. We thought Europe was in a recession or headed to a recession a year ago. Once again, that was kind of in the minority. And we also said not only a recession, a deep recession. And I'll tell you, with the data that's coming out literally on a daily basis, it's really proving that. And just one amazing statistic is that the unemployment rate in Spain right now is 26%. That's higher than it was in the US during the Great Depression. And it looks like it's stabilizing at 26%, but it doesn't look like it's improving. Grant was just pointing out to me that an important economic statistic came out of in France, and it was the worst in 46 months or something like that. Germany's doing well, even Germany's turned down, believe it or not, lately, but the rest of Europe, for the most part, is really sucking wind, and we did see that coming. Now, what about for 2013? That's what you're really here to hear about. And we have a little bit more sanguine view of the stock market. Not much, because we're giving ourselves a little more latitude. We think up a little, down a little, plus 5%, minus 5%. That's kind of the range that we think. Frankly, we would be much more concerned if it wasn't for the fact that we really do see the Fed continuing to print, and that's a misnomer, I admit, but create $85 billion a month of bogus money. And that is creating a tremendous amount of support for the stock market. But one thing that we hear all the time, and that I really disagree with, is you hear, well, the stock market is actually cheap. You'll hear somebody on CNBC saying it's only selling for 13 times earnings on future earnings basis. The problem is that, as I've written about, and I know many of you in here are reading our newsletter, and I really appreciate all the positive comments that you made earlier, but one of the themes that I've been harping on is this idea that price-earnings ratios they look low because profit margins are far beyond where they've ever been before. John Hussman, who's a brilliant guy, thinks they're 60 to 70% above normal. We think it's more like 15%. But if we're right, forget about John Hussman, if we're right, the PE is more like 17, 18 right now, not nearly as cheap as what it appears to be. You cannot base the market on peak earnings. That's just dumb. But it's amazing how often it happens. This is another way of looking. I don't know how many of you know who Bob Shiller is, but Bob Shiller is a brilliant guy. He called both the tech bubble and the housing bubble well in advance. And he's created this Shiller PE. And if you really know what you're doing in our business, you look at the Shiller PE. And right now, the Shiller PE is about 23 times. And if you look at this chart, what it shows you is, other than the bubble period when tech stocks were trading for 1,000 times earnings or whatever it was, or the prior to the 1929 crash, other than that and the aftermath of the bubble years, the stock market's actually quite expensive. And maybe it's not 40% overvalued. I don't think it is. Maybe it's 10 or 15. But let's be realistic. We've got some real serious challenges out there that we haven't had in past years. So, and here's a really sobering fact that maybe some of you saw last week, is that whenever the Shiller PE has been this high, the real return on the stock market over the next 10 years has averaged 1%. And that's just a historical fact. That's not something somebody's making up. Now that, again, that's adjusted for inflation, so that's not quite as bad as it sounds, but it's not great. So just something to be aware of, and something that we are concerned about longer term. Bonds, we've done extremely well with bonds. We made a major push, as many of you know, 5 or 6 years ago when we saw the recession coming, to buy bonds and other conservative income investments. And we've ridden this, and frankly, for most of my career, I've been a bond market bull most of the time. But we do think things are changing, and that, frankly, if it wasn't for the Fed creating the $1 trillion a year, we'd be more concerned. We don't think that you're going to have a major hit to the bond market this year. It could correct, but not a real bloodbath. We think the bloodbath, unfortunately, is coming, but probably not this year. And the reason not this year is that $1 trillion that the Fed is pumping into the bond market. There's only $1.3 trillion total high-grade debt issuance in the United States per year. So the Fed's buying almost all of it. So there's not a whole lot left over. So that's why we're not going to get too bearish on bonds yet. But we are watching very closely the velocity of money. As many of you know from reading the newsletter, the reason the Fed has been able to get away with this $2 trillion money creation is the money's not circulating. It's just stuck. But eventually that money will start to circulate. Our partners at Gavekal in Hong Kong are indicating that there is a pickup, but there was a false positive a few years ago, so we're not sure, but we're watching this very closely. That will be a big deal when it changes. As far as the economy goes, we don't think there's going to be a real recession, but we think something that's called, kind of euphemistically, a growth recession is very probable. Especially, again, this isn't an opinion, this is a fact. 40% of the world right now is in recession. Europe, the UK, and Japan are all clearly in recession. And if you look at the US economic indicators, such as I've shown you right here, they're not looking that great. Now, I wouldn't say that they're 2008 alarming, but they are concerning. This, I think, is really interesting. This is from Ed Hyman. His ISI company is one of the most highly regarded economic forecasting firms on the planet. And he's pointing out something really fascinating, and it's what I mentioned a year ago, which is there is this tendency since the Great Recession for the economy to perk up in the fourth quarter, first quarter, and then peak out in the spring. And notice, and maybe it's a coincidence, but it's been doing that each of the last 3 years prior to this one since the Great Recession. And it looks to be doing the same thing again. And notice also that each one of the peaks is lower, each one of the troughs is lower. If it was a stock, you'd say it's in a downtrend. So that's a bit of a concern. And I think maybe why all of a sudden, despite all that Fed money being pumped into the financial markets, or the financial system anyway, that what we've seen in the last few days is some economically sensitive items really coming under a lot of downward pressure. And I'm thinking that perhaps the market is getting wind of the fact that perhaps growth is going to be disappointing later this year. But again, we're not in the camp of looking for some kind of hard recession. We think there's a chance we can miss an outright recession. And we also try to look at both sides. There's definitely people I read that are, tend to be bullish or tend to be bearish. We just try to look for what is the truth. Because if you ignore the truth, you're probably going to lose money in the long run. And there are some things that look better. The ISM Manufacturing and Services Surveys, that stands for Institute of Supply Managers, they're improving, and those are important readings, that's good. I think one of the most positive things about the U.S. economy is what's happening in the housing market and in autos. I mean, during the Great Recession, those industries were absolutely nuked, and they're coming back. I mean, I think you can be, the trouble with the home building stocks is they've already gone nuts, but the auto stocks probably still have a fair amount of long-term upside. So that's good. Again, we want to be realistic about this. I would also throw in the energy boom, which we've been on that theme for years. That's the real deal. That's got legs for many years to come. So that's another positive I could have had up here. European crisis, clearly easing for now, but I would not hang your hat on the worst being over. I'm going to defer to Grant because he's got some fascinating stuff to talk about there. China looks to be growing again, but not rapidly, not the kind of hyper breakout that it had a few years ago after the recession. So as usual, we're just trying to weigh all these positives and negatives. And right now, we'd say that as far as the economy goes, it's a little bit on the concerning side. As far as Europe, again, another shoe to drop later this year. Once again, I'll leave that to Grant to really go into detail. Inflation, for, again, 30 years, I've been pretty much a believer that inflation would stay under control. And we still think that's the case, but we are worried about later in the decade. Grant and I were talking about this on the way over here, that all that money that the Fed has got in the system, they're going to have to take it out. And when they go to take it out, I think the congressional pressure is going to be unbearable. I do think Mr. Bernanke will be long gone by then, as a matter of fact. So we're more concerned a few years from now than we are right away. But certainly when it comes to the Fed, they are in the print mode completely. And the problem with this is that their balance sheet is now headed to $3 trillion. It used to be $700 billion, I think, Grant, before the crisis. So it's headed to over a $2 trillion excess money situation in the system. And what's, it's just incredible. If I told you this 6 years ago, you'd say, that's impossible. That's the kind of thing that only happens in a banana republic, and yet it's happening in the world's greatest superpower. But again, the reason they feel compelled to do this, which I think made some sense initially, but is now making less and less sense, is this collapse in money velocity that I mentioned to you. However, when money velocity begins to normalize, and it will, they're going to have to, the Fed will have to be a massive seller, a seller like we've never seen before, and it will undoubtedly be in a weak market. Just to give you one real-life anecdote about this, I know, Tyler, I'm probably going a little longer, but just in this week, because of a whiff that the Fed might end the money printing, not even reverse it, start selling, but just end it, some Asian bond markets actually fell 10% in just a couple of days. Imagine what would happen to even the U.S. bond market should they actually become a seller. It's a pretty sobering thought. One of the things that we're particularly worried about is that the carry trade, which caused a tremendous amount of damage 6-7 years ago, is back. Now, I'm just going to digress briefly to explain the carry trade. That's where leveraged institutions, think hedge funds, borrow money short term. Back then it was the yen because the yen was a cheap currency to borrow on. And then they buy longer term securities. The problem is when those longer term securities start going down, it's the classic margin call. And that's what we saw back in 2008 was a unbelievable global margin call. Now this time they didn't have to go to Japan. They could borrow the money freely from the Fed, and they've been doing that in enormous amounts. Mary Sue sitting up front, who's one of our great helpers in the bond area. In fact, she's our main bond expert, and she was telling me the other day that she knows of so many firms that are doing exactly that. And it's great as long as the prices are stable or rising and interest rates are stable, but when it goes the other way, it gets really ugly in a hurry. So I'm not trying to be alarmist, I'm just trying to be realistic because we do think there's going to be huge opportunities, and there are, frankly, safe harbors even now, which I'll talk about briefly. Fiscal policies, unfortunately, DC still in denial, huge denial. Forget all the fancy rationales that you hear about why it's okay. Just look at this chart. This is a chart of total government debt, and it looks like a housing chart from 2006. I mean, it's just the classic hockey stick. I mean, can that really continue? Federal debt since 1982 is up 16 times, GDP is only up 5 times. I mean, how many ways can you say unsustainable? Also, can this continue? Ironically, because of what the Fed has done by driving interest rates down to almost nothing, we're paying less to service that massive amount of debt than we were years ago when the debt levels were much lower. Now, what happens, though, when interest rates start going up? It becomes a very different situation. Now, I admit it's not going to happen anytime soon. We're really giving you more of a warning for a year or two out, but you never know, and I think we have to be protected in case things degrade sooner than that. As far as REITs go, they've cost us last year, I mean, very frankly, they cost our clients at least 100 basis points, which means 1% in English, of performance, and we hate that. But we also realize that when the trouble hits, that's going to be one of the best protections we have for a lot of our income equity investments like the master limited partnerships that we've made so much money on over the years. So it's a hedge, and a hedge in a rising market costs you some performance. That's just reality. Junk bonds, commodities, we think volatile but no disaster, but we do worry about junk bonds, particularly lower grade junk bonds, when that great unwind happens and the Fed has to become a seller. Because we think a lot of junk bonds are definitely owned on margin right now. Currencies, we think this is a big area. We've done a pretty good job for you, much better than with the REITs. We've made money on the euro, and then we've made very good money on the yen as it weakened here dramatically in the last few months. Ironically, the euro, as the yen has been weakening, the euro has been rising. And when I stood before you a year ago, I said I thought at the time it made more sense to be negative on the yen, and the euro was already beat up. Well, now it's completely reversed. So we're closing out our negative bet on the yen. We do think two of the best currencies to be in are the Canadian dollar and China's currency, the renminbi. And I'll talk about that briefly in a moment. This is why we like Canadian debt. I mean, it's pretty simple when you really think about it. Look at Canada's total debt level on the far right. Look at the UK, look at Japan. The US is kind of in the middle. Canada has dramatically lower debt levels than do most of the other rich countries. And they also have a central bank which is operating a kind of a Paul Volcker, very sound money policy. So we like that a lot for obvious reasons. So as a result, our favorite place is to earn some return while positioning away from the great levitation and the aftershocks of when it unwinds, Canadian dollar corporate bonds. So these are corporate bonds issued in Canadian dollars. And we can get 3.5% yields. At least it's better than earning 0 in cash in US dollars. So we think that this isn't exactly exciting, but we believe that we can get 3% plus maybe 3 to 4% of currency appreciation. And if there's a dollar crash, we might get a windfall profit there. We also like, as I mentioned, multinational bonds. Some people say, oh, geez, buying bonds in Hong Kong and renminbi, that seems kind of dicey, but these are issued by companies literally like Ford Motor. So they're big multinational companies that are choosing to issue their bonds in renminbi. And we do believe that China is positioning its currency as the alternative reserve currency. They're buying tons of gold. China is really hoarding gold. You can't get gold out of China. I think there's a chance that they could make their currency partially convertible into gold. We also like emerging market debt in local currencies. Many of you, there are clients, have made a lot of money with these bonds over the years. They've been great. But we're not as comfortable, frankly, because if there's a major panic, those will probably get hit. So it's kind of a half-hearted recommendation there. We also like floating rate U.S. debt. Many people are not aware that you can buy U.S. bonds that pay adjustable interest rates, so that if later in the decade inflation interest rates get out of control, you're not going to get hammered. In the 1970s, bond investors were absolutely brutalized by this, and actually stock investors were too. In the 1970s, having a balanced portfolio didn't do you any good. You got hit on both sides. We're concerned that we're moving into more of that kind of an environment. We also continue to like short maturity BB rated bonds, high grade junk. We've done very well with those over the years. So to wrap up, net, slightly up to slightly down year for both bonds and stocks, but be ready for shakeouts, but especially be ready for the great unwind that's coming. And again, that great unwind is when the Fed has to become a big seller instead of a big buyer. And we do think the currency you hold is increasingly important. And most people don't think that way, but I really believe with so much of the world trying to trash their currencies, go to those countries that are actually trying to enhance their currencies. That's kind of simplistic, but I think sometimes the simple way is the best way. And I want to be very candid with clients and potential clients. I think in a period like this, where there's a lot of distortion going on, Grant had a great term for it, what was it, pricing corruption? But pricing corruption of pricing signals, because the Fed is, you can't really tell what things are worth right now because of what the Fed is doing. And we don't like that kind of stuff. So we tend to kind of hunker down when that was going on, and that often leads us to trail the popular averages. So far so good, mostly because of our income securities, but be ready that we may not have as good a year relative to the benchmarks as we have in the past. But I also think we're positioning well for when the next crisis hits, and we will plan to pounce on that. So really, I'm circling all the way back to where we started with Will Rogers, because one of his famous lines from back in the 30s was, I care about the return of my money, not the return on my money. And I really do think, like the 1930s, we're moving into that kind of an atmosphere. So thank you very much for hearing me out, and now we're ready for the start. Thank you.
So a lot of what Dave spoke about there, he's led me in really, really nicely. And a lot of what I'm going to talk about is this idea about corruption. And when we talk about corruption, the term's kind of been abrogated so that people think it means money in envelopes. But what I'm talking about is the corruption, the impurities that we have now everywhere we look in the markets. There are no true price signals anymore. And Dave and I were talking about this earlier on. You know, we've both been in this business. Dave a little longer than me, but I'm pushing 30 years now. And at no point in those 30 years has it been easier to determine what's going to happen. But at the same time, it's never been harder to figure out when it's going to happen. And that's purely due to the corruption of these traditional price signals that guys like Dave and myself sit down and try and interpret in order to figure out what's going to happen in these markets. So I have a few slides for you. They're going to speak to that. And this is, it's a bit jumbled, but it's a really important slide here. So on the left of that red dotted line, there are 38 countries or regions in the world that currently have negative or zero real interest rates. And this is absolutely unprecedented. This has never happened before in the history of economics. And this is the main reason why people are struggling to figure out what to do with their money and where to get a return today. And it's a very deliberate ploy on behalf of these central banks to try and cure the debt ailments that they all currently struggle with. So you've got the entire G7 there with negative real rates. You've got the whole of the Eurozone ex Malta, which I think we can probably safely leave out. Apologies to any Maltese in the audience this evening. And the others there, these are also negative real rates. We've got quantitative easers. We've got 5 of the biggest central banks in the world all printing money out of thin air, which currently seems like a good idea, but I think we can all agree that you really can't print money out of thin air and expect it to last forever. And then on the right there is a list of countries that are still in the manipulation, the jawboning stage, the talking of currencies lower. But all these countries need negative real rates. They all need to try and force capital into places where it really shouldn't want to go. This slide is kind of terrifying to me. And this is what financial repression looks like. Just 5 years ago, tail end of 2007, if you had $10 million saved up, you could invest that in 2-year US Treasuries with essentially no risk whatsoever and get an income of $480,000 a year. And now that same investment will bring you in $24,000. That is financial repression. That one slide there is exactly what's happening. And this is a very, very deliberate strategy. Make no bones about it. That $480,000, that $10 million rather, they can't have that sitting somewhere safely earning interest. They need that money in the economy. They need it invested. They need to get these economies growing. This is going to continue, and it's going to get worse if it possibly can. If they can find more ways to squeeze this lower, this is what they're going to try and do. Where are people going? Well, they're going all the places they shouldn't. You know, Dave is sitting there talking about how we think we can get 3%, 3.5%, and that's a good return when rates are negative. 3.5% is a very nice return. We've got people buying junk bonds here, as you can see. This is the Bank of America Merrill Lynch High Yield Master 2 Index, which is a benchmark junk bond index, and currently it yields less than 6% for junk bonds. And I think we can all agree that 6% for junk bonds is not really the world that many of us in this room are used to investing in. Another great symbol of what's going on here, this is the VIX. So this sense that the government have kind of got this all under control and they're going to keep everything stable for a long, long time. The VIX is it's an index that measures volatility. So you can see these big spikes here. The big one in the middle there, that's 2008. And as you can see, it tends to subside fairly quickly. You can see further scares in 2010. There's one on the right there, 2011. That was Fukushima, the earthquake in Japan. And things tend to settle down. But the market, in terms of complacency and fear of risk, is back where it was in 2005, 2006. So when people say that it's almost like 2008 never happened, in terms of people's perception of the risk out there, it really hasn't. I mean, we are literally back to where we were when everything was great and markets were going to go up forever. Meanwhile, despite the central banks trying to force you good people to put your monies into junk bonds and to chase yield in all kinds of bizarre places, 3/4 of their own reserves are held in gold bullion. And again, that's a very, very deliberate thing for them to do. You will never hear a central banker telling you that owning gold is a good thing to do, and yet in the West, say 3/4 of these countries' reserves are held in gold bullion. I have another slide that's actually not in this deck, but it just shows you who's been buying gold bullion. These countries haven't sold any gold for a number of years, but they're certainly not adding to their holdings. Meanwhile, places like Korea and Mexico and the Philippines, Thailand, India, China, I mean, the list of emerging economies that are voraciously buying gold. You know, the top producer of gold in the world now is China. They don't export a single ounce of gold. Russia, similarly the second biggest producer, they don't export a single ounce of gold. And the Russian central bank very kindly announce every month on their website how much gold they bought, and they are buying gold every single month. So gold as an investment, and we can get into that in the Q&A, should be a very important part of people's portfolios, and not from an emotional standpoint where people kind of find gold this lightning rod for everything that's good and bad in the world, and you get into some very heated debates about whether it's a good thing or a bad thing. As a means of storing some of your wealth, you can put it in the bank, in paper money, electronic money, and earn zero, or you can have a physical piece of metal that has always been wealth for 6,000 years. It won't pay you any interest either, but it's money good wherever you want to take it, whenever you want to take it there. Now this is essentially the corner that the central banks have backed themselves into. And this vicious circle is going to continue until something breaks out somewhere. We've had the fear stage, so what do the central banks do? They buy a whole bunch of bonds. When they do that with the express intention of lowering yields and bringing down borrowing costs to try and stimulate the economy. When that happens, and we're in this phase now, you can see my little "you are here" sign there, confidence returns. Now, there's two kinds of confidence. There's confidence that the central banks and the government have, and they try and instill in us, and there's the kind of confidence we have in that we really do want to take our money out of the bank and invest it. And I don't think we're quite there yet. The problem is when enough people start listening to the governments and the central banks and really genuinely start to believe that things are okay again, the first casualty of that is going to be bonds. Because why would you hold a US government bond paying you 6 basis points for a 2-year treasury if you think everything's okay and the economy's going to grow? So those bonds will be sold. Once the bonds get sold, the yields start to rise again and the fear returns. And this is a vicious circle. I don't know which part of this breaks, but at some point it's going to have to break because this can't go around forever. Dave touched on Europe. Now I took this from another presentation I did, and in that presentation it scrolls, and it scrolls on forever, believe me. These are the comments from various heads of state, various finance ministers around Europe, going back to December 2009, when Brian Lenihan, God rest his soul, the Irish Minister of Finance, said that the plan is working, we've turned the corner. So that was pushing 4 years ago now, and they've been turning the corner ever since. It must be a pretty big corner. But as you can see, this is right across. This is right across Europe, and this is, in text form, this is the attempts to try and instill confidence. And here's the next one, still turning the corner. We're into March 2012 now. It's the same. We've turned a corner, the crisis is over. There never was a crisis in the first place, obviously, but had there been, it's over. We're stabilising. Slide 3, we're almost there, January 2013 now. And this actually, if you look in detail at these slides, it goes through several presidents in several different countries. So it's a long process. But are we almost there? No, we're really not. Europe is going to flare up again at some point this year, believe me. Dave mentioned the Spanish unemployment situation, and this slide touches on that. The Great Depression is this great epic disaster that everybody references whenever they want to talk about how bad things could get. How bad could things get? We don't want to. We'll do anything we can to avoid another Great Depression. Well, this is the Great Depression. That red line there you see is US unemployment through the Great Depression. As you can see, it peaked slightly above 20%. So currently in Europe, we have 2 countries. Greece, which everybody kind of is a little bit over by now. It's not that big a country, and we keep getting told it doesn't matter. They're at 26.7% and climbing. More importantly, we've got Spain, which is the 4th biggest country in the Eurozone, and therefore the 4th biggest contributor to all the bailout packages. It's the 12th largest economy in the world. Their unemployment is currently 27% and climbing, both way worse than the Great Depression, and yet we're being told that it's fine. It's not fine. It hasn't been fine for a long time. It's not going to be fine for some time to come. Incidentally, in those 2 countries, youth unemployment amongst under 25s is 56%. And when you have 1 in 2 guys and girls under 25 unemployed and you go into the heat of a Mediterranean summer, trouble is going to happen. I can guarantee you that. At some point there are going to be more protests in Athens, more protests in Madrid, and it's going to start getting out of hand because very kindly the Spanish government have thrown to the press a very nice little bribery and corruption scandal that goes right the way up to Prime Minister Mariano Rajoy and may actually mean that he has to step down. I know, Spanish politicians, corruption, who'd have thunk it, eh? So we'll see, but there are plenty of things that will conspire to bring Europe back to the front pages, and when that happens, we saw last year, as Europe goes, so goes the rest of the world. So that's really the quick and dirty that I had for you in terms of slides, but I'm sure we're going to sit up here, and I'm very, very happy to take any questions you might have about any number of topics. So thank you very much for listening.
Good evening. Thanks for coming once again. My name's Jeff Dix. I'm an analyst here at Evergreen. My colleague Mike Wiseman, Mike right here, we're going to facilitate the Q&A. If you have any questions, raise your hands. We're going to start off with a few generic questions, and then we'll turn it over to the audience. This is a question for Jeff Yulberg, our Director of Wealth Management. Jeff deals with clients on a daily basis. Jeff, can you address some of the most common questions you've received from clients lately?
Yeah. We didn't test this before. Does that sound good? So like Tyler said, my wife went into labor on Saturday. So we kind of decided that I'd get kind of a softball question that I can answer in my sleep, because essentially I am in my sleep right now. But the most common question, obviously, that we get, or that I've received recently, Dave's already somewhat addressed that, and that was SRS, the real estate short that we have within your portfolios. We don't want to dive too much into every single portfolio position that we have. It's really not the forum for this. But what I say to clients and what we see with SRS, the most common things, first with that position, like Dave stated, it's really a hedge for our income portfolios. So the fact that you're frustrated with that position means that everything else pretty much in the income portfolio has done really well. And that's why we have that in the portfolio. We see that area of the market as probably the most overvalued part of the income portfolio. And it goes to what Grant was just saying. The new income investors that are looking for safety now are reaching out, and they're going after high-yielding equities and REITs. And you're seeing the yields that traditionally come from REITs at 5% going down to now about 2.5%. We could go into underlying valuations of REITs. They're at all-time high levels. You just have new investors not paying attention to the fundamentals on REITs, and we definitely think it'll correct from where it is. And we don't necessarily think that it has to be directly in line with a major correction in the income world. REITs are so overvalued that we think they could decouple from the income investments and still correct while you still hold well, or your income investments hold up well. But that's definitely an area that we have in there. And quite honestly, like I said, I hope next year we're sitting here and defending our REITs, because most likely that'll mean that the rest of the income portfolio is done really well. The next most common question that we've gotten over the last 6 months, I realized how, I mean, I knew this before, but the extent of how much everyone wants to talk about Apple. Last night when I was up at about 4 in the morning watching CNBC World, they spent an hour just talking about Apple when they were talking on the European markets. But so clients, after Apple's correct about 38% from its peak, wonder if we still want to stay with that position. What do we think about that? I personally, speaking for myself, I think Apple's probably the most attractive investment that you can buy at this point in time. When you look at valuation right now on Apple, it's trading about 10 times earnings. That's future earnings. Like Dave said, the market's trading at about 13 or 14 times earnings. Apple has about $130 billion in cash on their balance sheet. They've got a fortress balance sheet. I'd like to say it's the Fort Knox of balance sheets, but Grant might not agree that that's that stable. So really, to put that in perspective, I can say you have $130 billion in cash, and I think a lot of clients will say that's a lot, but they don't really understand how much that really is. So I looked at some market caps and some companies that you'd be aware of to see, okay, if Apple wanted to put that cash to work, what could they do? What could they buy right now? They could buy a little company called Disney and still have $35 billion in cash, just based on their market cap right now. They could buy Pepsi and still have cash left over on their market cap or on their balance sheet and have no debt. And that's just a tremendous amount of cash that Apple can put to work. A lot of clients will say, but they haven't done it. And we agree with that. Steve Jobs was pretty adamant about keeping cash and waiting until he thought the investments were appropriate. We think Tim Cook will start to utilize that cash because now they actually need to look for other avenues of growth. To put that in perspective again, they could buy 13 Netflixes if they want to with the cash that they have. So we still love Apple. We think they're one of the most innovative companies in the world. At 10 times earnings, I just cannot find a better investment than Apple. So I think we would continue to buy it. We have traded it quite well throughout this run for longer clients. We bought it all the way back in 2006, and we've trimmed on the way up. So for most of the clients, you're probably not even, you've already returned your original investment, and you're kind of playing with house money at this point in time. So we just think that it's a great portfolio position, and we'll continue to have it. So those are the two most common.
I'm sorry about the glare off my head. I should have been on that side, Jeff. It was poor planning. The next question is almost anybody out there in our group, but over the last 4 years, the price of gold bullion has been fairly steady. Yet recently, our stocks have been kind of lagging, and our gold stocks, our gold miner stocks, that is, have been kind of lagging the market. So would you like to talk about that? Maybe
I probably should address that one since I get the primary responsibility for having them in the portfolio. And it's true. Actually, gold has done quite well. You know, people look at last year and they say gold was disappointing, but it was up, what, 10% roughly last year?
Yeah, about 9. Yeah,
Not a bad year. Just looked less than, it was less than the stock market. But this year it is down. And even when gold was behaving well, gold mining stocks weren't. And we were, admittedly, very surprised by that. We thought that the gold miners would catch up. That still may happen. However, this is an important point, and I think this is really a great question for this reason. Many of you may not be aware, I think some of you are, that we have a very rigid sell discipline at Evergreen that has been developed out of that most instructive of all schools, the School of Hard Knocks, where you learn that one of the worst things you can do in our business is to fall in love with the stock, keep buying it on the way down, and seeing it implode. There's just been way too many stocks that have done that, even blue chip names like Lucent. And there's been certain, I won't name their names, but one of the most famous portfolio managers in the world ruined his track record doing exactly that. So I think it's important for you to realize that when we see a 3-year support level broken, so if a stock has been trading, let's just look at a Barrick, for example, which is the largest gold miner in the world. And basically the low 30s has been its low point for the last 3 years. This week, it broke that. Yesterday, we sold it. And frankly, Newmont also broke 3-year support. We decided to hold on here for a couple of days. Unfortunately, they did report good earnings, but we will soon be selling Newmont as well. Hate to do it, could be wrong, but I will tell you, we've gone back and looked at this statistically, and you can go back and look at the stocks we've done this to over the last couple of years. It works most of the time. Nothing in our business works all the time, but it works most of the time. Now, that doesn't mean we won't buy another gold miner. That doesn't mean we won't come back into them later. There were a couple of companies we recently bought that we had sold on that basis a year and a half ago. But frankly, we're not sure. I mean, Grant and I were talking about this earlier today. If you were to create a scenario where gold and gold mining stocks should be doing really well, this is that scenario, and they're not. And so maybe we're missing something. Maybe we are going to get a severe growth scare again, which is going to create deflation fears. I don't know. But we are moving to the sidelines temporarily on the gold miners. Now, we do have gold. It's interesting that the biggest bond manager in the world, Bill Gross, when he was asked in the Barron's Roundtable here recently what his favorite investment was, this guy's a bond. You know, he's the bond king. PIMCO manages, I don't know, close to $1 trillion in bond assets, and he said my number one investment pick is gold. Now, he's not always, his timing isn't impeccable like the rest of us, and gold has been going down ever since he said that. But I think that's indicative that there is some underlying appeal for gold. And what I think is interesting, I mean, if we're contrarians, as I think most of you know, and it's not easy being a contrarian because you're usually early. But I will say right now, when you look at gold, it's the sentiment on it. I think you said today that the bearish sentiment on gold is the highest, or the bullish sentiment's the lowest it's been since 2008.
Prior to, we're below the 2008 bottom.
So we've gone from, and one of the things, we trimmed back on gold a couple of years ago because you turn on CNBC and you'd see everybody talking about gold. We had some of our kind of bellwether clients calling up and saying we need more gold, and all that's gone full circle. We're now in a position where the average investor has decided that gold doesn't work. And they may be right for a while, but getting back to that slide I showed earlier, when the central banks have created $10 trillion of funny money over the last 6 years or so, and I think there's only $6 trillion of gold in existence. So it's about that. Someday, I still believe, could be wrong, but I still believe we have one vertical move left in gold. And eventually the gold miners will catch a bid and start going up. But for right now, we're doing damage control.
I'd just add something to that, actually, because this is a question I get asked a lot as well. And when we have, in our portfolio in Singapore, we have a bunch of gold mining stocks. Gold's a funny asset because it doesn't have any simple means to evaluate it. It doesn't spit out any earnings. It doesn't throw off any yield. It's a lump of useless metal, a lot of people say. But as I said before, it has been money good for 6,000 years, and that's not going to change. And so because you can't really analyze it fundamentally, it tends to be a very, very emotional asset class. And because of that, it sucks people in at all the wrong times, and it spits them out at all the wrong times. When gold was at 1900 last year, it was the greatest investment in the world, and people couldn't jump in fast enough. It went from 1900 back to 1700, which in the context of a decade-long bull market was a very, very healthy correction. But the difference between a correction and a collapse is purely your entry price. If you'd have bought gold at $600, seen it up to 1900 and it come back to 1700, that's a correction. If you bought it at 1900 and it went to 1700, that's a collapse. And so people, I mean, it's the question I get asked the most. People are so fundamentally entangled emotionally in these gold investments. And because of that, the gold mining stocks currently probably offer some of the best value in the S&P 500. And Newmont Mining, which David's talking about, is the only gold mining stock in the S&P 500. And it throws off a 4.2% dividend. And it trades on about 13 or 14 times earnings. It's a very, very good value stock. But value investors have not been looking at the gold market for some time now. It begs the question who's selling these things, because these gold miners have been incredibly unloved for a long, long time now, and they've underperformed the gold price itself quite significantly, particularly in the last year. And so there's a hint of capitulation in the gold mining stocks at the moment, and yet if you price the gold mining stocks in ounces of gold, which is to me the most sensible thing to do, that's what they have in the ground, that's what they dig up, that's what they sell. These mining stocks have literally never been cheaper, never, at any point in their existence. And so trying to find the right way to value gold and trying not to get too emotional about it, I think to value them in ounces of gold is a very sensible way to do that. On that metric, they're very cheap. If you want to look at fundamentals, as I say, Newmont at 4.2% dividend yield is a lot better than you're going to get owning the S&P in a broader sense. And so these kind of violent corrections that you see in emotionally charged stocks are actually quite normal. It's tough to stay in them. Sometimes it's tough to buy them when everybody else is selling them, but that's really what you have to do. And being a contrarian investor is all about doing that. So I wouldn't, I think these calls for the gold bull market being over are extremely premature. As David said, quite rightly, there's never been a more conducive atmosphere to rising gold prices than central banks all around the world literally spewing out money made of paper at will. And that's going to continue for some time. They're not going to be able to exit anytime soon. The UK have announced today that having stopped their own QE program about 3 months ago, they see that there may be some room for another £175 billion of quantitative easing. What's another 175 billion amongst friends? It's, pretty soon you're talking about real money, right? So yeah, I think beware the emotion of looking at gold, and try and look at the fundamentals and try and value these things in the correct way, and not read the media saying, you know, gold mining stocks are a terrible investment. They're actually not a terrible investment in times like this.
Thanks, Grant. One last predetermined question, and then if you could raise your hand, we'd love to come around. What risks are underappreciated by most investors given the conditions created by?
I think that in investing, it's not the risks that you know about that are what really hurt your portfolio or your wealth over the long run. I think it's the risks that you accidentally take that are very damaging to a portfolio. And right now, anybody that took Finance 101 remembers the risk return chart that starts with cash is the least risky, but gets you the least return. Then you go to treasuries, then you go to corporates, and then you go to large cap US stocks, and you go to emerging market stocks. You work your way up the risk profile. And I was looking at it last week, and I sent it over to Charles Gov, our partner in Hong Kong, who's Louis' father, and Louis is the CEO of GovCal. They write some of the best macro research in the world. And I said, does anything strike you as interesting when you're looking at this? And he said, oh yeah, just one small thing. It's completely backwards. And when you think about that, it's pretty profound. People are graduating and going into the business world, and people who have been in the business world for 30 years are still building portfolios using this risk return model where you look at cash and treasuries and you think, oh, I have a lot of cash, I have a lot of treasuries in my portfolio, I can't get hurt. I have a lot of, I don't want another 08. Let's hold cash, stocks, or let's not hold stocks, let's hold cash, treasury. And you start ramping that up in your portfolio because you're worried about the stuff that you're hearing on CNBC that all this printing is going to come to a bad end, and really all you're doing is taking on more risk. You think you're getting more defensive because you hear all the predictions of this has to end badly, and all you're doing is increasing the risk in your portfolio. And Dave pointed out earlier that we don't think necessarily inflation is going to hit this year, but at some point, this much money printing, it has to end badly. So I think that's probably the most dangerous, unappreciated risk out there. And we'll try to keep the responses brief so that we can get through as many questions as possible. Someone be brave.
Mike the mic.
We got one here first.
Go ahead.
Go ahead.
Okay, so this may be, David, this may be for you, but can you comment a little bit about U.S. housing starts, not just 2013, but maybe 14 and 15?
I don't think there's any question we made a bottom. That was one of our calls for last year, that housing would bottom and turn up. I do think that it's important to realize that a lot of the better activity in housing is frankly investor driven, where you've got major institutional investors going in and buying homes and renting them out. Housing starts themselves have improved, but boy, you look at the graph, and I ran this in EVA not too long ago, and you almost got to get the magnifying glass out to see the turn up. But it is better, and obviously I think the Seattle area is one of the better housing markets. So actually I think that because of that, because it's just early after a devastating bear market and housing starts collapsed, went way below household formations, lots of pent-up demand, I don't think there's any question that housing starts are in a long-term uptrend that can run for years and years and years. The investment implications are, I mean, if we were surprised how quickly the home builder stocks have moved, and I think they're way ahead of themselves. At some point, we may look in that area if there is a really severe shakeout. Our plan was to focus more on the auto side because we thought autos was a bit of a safer bet. But in general, I think housing starts are headed up for years, frankly.
I think that's a good point, going back to the REITs. A lot of our clients see that we're short real estate, and we get the question, well, why are you short real estate? And you think that the housing recovery is going to be this next year. Obviously, the REITs that we're short are commercial property and multifamily, so it's apartments. So if we do see a recovery in the housing market, that'll actually negatively affect a lot of the REITs that we own. As renters move to homeowners and start purchasing, you'll see multifamily housing start to sell off. So that's a big question that clients kind of have a disconnect with as well, the real estate short.
I've got a question from a client over here. Today, Bernanke and the Fed wavered on the bond market. What is the short and long-term effect of that?
Well, I guess I would say that it's just words. And I think what you're hearing is some vocal dissent from the people who are worried about the same things we're worried about. But right now, the Fed is definitely controlled by the anti-Paul Volcker, Ben Bernanke. How does Mark Faber say his name? Faber say?
Mr. Bernanke.
Mr. Bernanke.
Yeah.
He's an Austrian,
4 A's, I think.
crazy Austrian who thinks the Fed is sowing the seeds of their own destruction, and we would agree with that. But the reality is the Fed is being run by these very easy money folks, and one of the predictions that Grant agrees with is that I believe that Ben Bernanke is not going to re-up. I think he knows that what's coming is going to be extremely chaotic, and his term comes up in about a year, and I think he's going to go off back to academia and leave his buddy, his partner in crime, so to speak, Janet Yellen, to clean things up, who's also extremely print happy. So I think what this noise here lately is, that's all it is, and the Fed is really committed to continuing to print until they get unemployment to 6.5%. One of the best economists out there who called a housing bubble, David Rosenberg, believes that's going to take years. I don't think it's going to take years, but it's going to take a while. And that means you could be looking at another trillion next year as well. I don't know when the music's going to stop and the day of reckoning occurs, but what I do know is the more they print, the tougher it is for them to get out from under it. And I just think that's being missed right now by most people in the market. They're just enjoying this, this heroin high that the fixer Fed is creating. And they're not thinking about what's going to happen when it has to go the other way. And admittedly, it's not going to happen right away. But I think this is one of those things that could be so powerful that you just have to be ahead of it.
I'd actually add just one point there. Everybody talks about this in terms of the Fed making this decision consciously, and the Fed deciding, hey, we will end quantitative easing on this date, and we will withdraw the stimulus. That's not going to be how this thing's going to play out. That's not a decision that they are going to take. It's going to be made for them by the bond market at some point in time. And this idea of the bond vigilantes, something we were discussing this morning. The bond vigilantes is not a charitable organisation. It's not a not-for-profit organisation. They were trying to make money, pure and simple. And back in the 70s, it reached a point where taking the other side of the government trade was the way to make money. Right now, if you can borrow money at 0% and you can buy backstopped Greek bonds, which are the debt of a bankrupt nation, and get paid 9% interest, hey, I'd be a borrower of bonds too. You know that they're going to be looked after. You know that for a year you can make that money. It's a pretty safe bet. So the bond vigilantes right now are riding on the back of the government, and they're riding them hard all the way to the finish line. But at some point, the math is not going to work anymore. And whatever Mr. Bernanke and his cohorts at the FOMC decide to do, it's not going to be their decision. So be very, very careful about listening and waiting for the Fed to tell you when this is going to stop. It's not going to go that way.
Right, I think that the idea that the Fed is going to know the perfect timing is kind of laughable. I mean, then it would beg the question of what has every Fed chairman before him been doing, because they've missed a couple of bubbles.
Well, this is the same Fed that brought you the contained subprime debacle, don't forget. It's the very same Fed.
And you also saw it a little bit on Wednesday when those Fed minutes were released. There was just a hint of maybe we'll stop easing earlier, and the market immediately sells off. So when they actually do, the market's not going to react well to that.
I have a question. That's a comment. We had a lot of MLPs in our portfolio, 2008 and 9. We have very few now. Do we see us going back to picking up more MLPs in the future? Is that the question? Sir.
We actually do own quite a few MLPs, and I don't know that specific situation. It's true that lately, and by lately I mean the last week or so, we've been trimming back because they've had a monster positive move this year. They've dramatically outperformed stocks after lagging last year. So we are not negative on MLPs, but one thing to be aware of that we wrestle with. I mean, we've had clients, CPAs call us up and say, never buy MLPs for my clients. I've heard that because I've been buying MLPs for 20 years. And for a long time, I felt like the Lone Ranger, and there was no Tonto at my side on this whole thing. And ironically, if you look at these last 12, 13 difficult years in the financial markets, MLPs have returned 18% per year. And ours have actually outperformed by about 2%. So ours have returned around 20% a year. I wish I'd had all your money. I said this last year, all your money in MLPs. But I've never taken so much heat as I have for owning MLPs because of the K1 issue. And this, I think, might be the situation in this particular client's case, because with smaller portfolios, we really wrestle with that, the cost benefit of the K1 and the preparation versus the potential return. So it's, we do run customized portfolio, everybody's different, but in general, we actually upped our MLP wagers last year when they were getting beat up in the fourth quarter of last year, a lot of it related to tax uncertainty. But then again, they've just had this great rally and we've been taking some profits. Interestingly, today they were getting hit. And one thing to be aware of is, as much as we like the way they're positioned, because as I think most of you know, the great thing about MLPs, unlike real estate, is they're right in the heart of this long-term boom in our energy production. And that's one of the, I mentioned it earlier, but it's one of the things we should all feel great about once we get through the next crisis, is that we are, they used to say the United States is the Saudi Arabia of food. Well, we might soon be the Saudi Arabia of oil and natural gas as well. Those are a couple of pretty nice commodities to really dominate. And the MLPs operate the pipelines, they operate the storage facilities, the gas fractionation plants. They're really in a great position to benefit from this ongoing boom. So we like them, but we also realize that a lot of these forces that we've talked about, the great unwind that the Fed is going to have to do at some point, that's going to be really tough on MLPs too. We're not naive. And so when they do run up like they have lately, we will take some profits. And when they get hit, we'll be back in there buying them up again. So I'm enormously wealthy in the last month or so, and neither one of them had ever had MLPs. And I know that most people don't really know. Now you see it more on CNBC, and so they're starting to get more press. Now, well, the reality is, even as much as they've rallied, you can still get 6 to 7%. He's a CPA, so he's happy because it gets him more revenue. So now and that is actually, to be very candid with you, that's an unusual aspect about Evergreen. Most investment advisors do not traffic in MLPs. And I think it's because there's been a couple of phone calls that came in over the years, oh, I hate those K1s, and they just stay away from them. Again, we're contrarians. We're willing to take some heat if we really believe in something.
I have 2 questions, actually 3 questions on this side. First one is, can you look into your crystal ball and predict the final outcome of the sequester and what the ripple effects will be in the end? Which is March 1 is the sequester. It's 1.2 billion.
I'm English. I plead the 5th. We can do that, right? We can plead the 5th in England?
Sure. That's English law. Who's going to take a stab at that?
Start, and I'll probably add my 2 cents.
Okay, so as I understood the question, I didn't hear it fully, but it's something about what are the odds of the sequestration turning out badly?
Let's see, can you look into your crystal ball and predict the final outcome of the sequester?
Okay, well, that's sort of what I thought. So,
Then also the ripple effects when all the money goes away.
Well, that's a biggie. I don't think we should beat the dead horse there, because there's just no question that that's got to happen. There's just no way around. Well, let's take that point first, and then I'll come back to the sequester issue. Let's assume that the Fed doesn't do anything, and they've got this enormous amount of money in the system. As one of the Fed presidents, the Philadelphia Federal Reserve President Charles Plosser said recently, if we leave the amount of money they have in there right now, not what it's going to be the end of this year, when it's going to be another 800 billion larger, but if just what it is now, if they don't take it out when that money velocity starts to accelerate again, consumer prices will triple. That's known as hyperinflation. That's something to be obviously very concerned about. Now, I think the Fed, being the central bankers they are, will try to avoid that. But the problem is that when I tried to paint the scenario earlier, when they try to start selling, let's say they want to sell $200 billion worth of bonds. Once that word gets out, and that word will get out, like Grant said, and he's exactly right, those bond market vigilantes who are helping them right now will become their worst enemy. So you'll have everybody trying to sell at the same time. And what's going to happen is that interest rates are going to spike. It's going to threaten whatever economic recovery is underway at that point. And then Congress, particularly certain members of Congress, are going to come down on the Fed like crazy. And I think as somebody like a Janet Yellen, if I'm right about her being the successor to Ben Bernanke, is going to have a very hard time resisting that pressure. But that's what we're going to have to find out. I think it's kind of binary. Either the Fed doesn't do enough and we have inflation get out of control, or they do what they need to do and we have some pretty serious consequences, but at least we get the pain out of the way quicker. As far as what's going to happen at supposedly the end of this month, I don't know. I mean, there's been so many of these games of chicken over the last couple of years, but I do think this one is pretty serious. And I think what happens is because they've, it's the classic can kick. The can's been kicked so many times, the assumption is it'll be kicked again. One of these times it won't be kicked. Maybe this will be it. I don't know. I don't think it's frankly the end of the world if these cuts go through, but it will be another drag for the economy. And there's two other drags which I don't think are getting much credit. One is the payroll tax jump that's occurred. That's definitely, I think that's why Walmart, you may have seen it, Walmart said that their year is off to a disastrous start because their customers are the ones that, a couple $100 of payroll tax increase is a big deal. The other thing which is not getting much press is that pump prices, gasoline prices have gone up for like 33 straight days. That really matters. It's about a 13% increase, which in dollars translates to $60 billion. So there's been a $60 billion hit to consumer disposable income in the last month. So you got kind of a multiple things piling up, and that's when you can get another growth scare, such as I was talking about earlier. So I don't think on its own that it's going to be that disastrous, but in combination with these other factors, it's definitely something to be concerned about. And as Grant pointed out, if everybody was worried, we wouldn't be that worried. But when you look at that volatility index, which is a measure of fear, and you can look at just about every other way of measuring fear, fear in the marketplace is extremely low right now. And I think that's one reason gold's struggling. Because gold is one of those things, when people are scared, they go to gold. So it's all telling us the same thing, that investors are very complacent right now. That makes us very worried.
I think I might add a couple things that when you look at, you can talk about the deficit and all the different areas to cut, but when you look at every CBO projection, really the major headwind that we have to deal with is healthcare costs, and the sequester doesn't deal with that. And I have a little thing to share in terms of just the deficit. And I'm sure a lot of you have seen this, but some of you haven't. But to put our current budget deficit situation into perspective in terms of the average American family, it looks something like this. The annual family income is $21,000. The money spent by the family in the last year was $38,000. They added $16,000 in credit card debt, and their current outstanding balance on credit card debt was $142,000. So there's a lot of work to be done, and the sequester is probably not the end-all be-all solution.
Yeah, I think the one unique thing or the good thing about having an investment committee is we don't always agree, but at this point in time, I think that we mostly do agree. The politicians in Washington are looking at this just like they did the fiscal cliff. They're trying to try out the market and see how much they'll get from them. So I think they would like to kick the can down the road and kind of we'll deal with this later. If the market allows them to do that, I think that's likely to happen, or some sort of adjustment will take place. If they won't, I think that they'll do whatever the market lets them do. But I think we all kind of agree that it's not going to be a huge event over the next 6 months.
Jeff, do you have a question there? Go ahead.
You sort of hit on this a little bit. I'd like to know what the healthcare effect is right now with a continuing presidency. How is that going to affect the market? How will it affect stock picks?
Well, how it's going to affect the overall market, I think we still have to wait and see once the Affordable Care Act is put into place. Right now, it's pretty much all based on projections. So what Tyler was talking about just now about the projections and how the CBO is budgeting our deficit and how that's going to play out, it looks like it's manageable for the first 6 years until about 2018, and then we have these meteoric rises in healthcare spending. If we see that and we make no adjustments, it's just simple that we can't do that, and the market will sell off because of that. How it affects individual stock picks, I spend a lot of time researching the healthcare sector for us, and to be quite honest with you, I would say that we're kind of being cowardice on our healthcare picks because we don't know how it's going to play out. So if you look at the portfolio right now, we don't have any managed care companies in our portfolio because we just don't know how they're going to be affected. They're going to have increased enrollees, but are they going to lose on some Medicare reimbursements that they get? So we're trying to right now play the ancillary healthcare companies, so like Becton Dickinson, McKesson, who's a drug distributor company. Those companies that we don't feel like are going to be specifically in the limelight for the Affordable Care Act cuts, those are how we're trying to play the act.
And if I could just chime in with a concise answer, I think Obamacare is going to be a disaster. And I say that even though I actually think it makes a lot of economic sense to have universal health care under the right conditions, but the way the legislation is drafted right now is it's going to contract supply and it's going to elevate demand, and that's going to lead to rampant price increases, which we're already seeing, or rationing, much as they have in the UK. I mean, if you have an issue, like let's say you need you need a hearing operation, something like that, so it's not life-threatening. I mean, how long can you potentially wait in the UK to have that operation?
Pardon?
Obviously, a very long time.
No, it's the UK health system is a joke in the UK for waiting times. I mean, you can be waiting years if it's non-life-threatening. Literally, you can be waiting years to have an operation in the UK, and we don't have so many people on private healthcare plans. It's more of a luxury in the UK. Oh, by the way, if anyone sees an article about Obamacare pointing out how many extra people are going to be hired, could you forward it to me? Because I'd like to read that. I've read plenty of other ones, but I've yet to read that one.
Next question is over here.
Thanks. David, if I understand correctly, you and Anatoly have a kind of a disagreement regarding the unwinding of the consequences of QE and the unwinding thereof. Could you discuss your views and Anatoly's views?
Sure. And I should explain who Anatoly is. Anatoly is he's the cow in GavCal. And Anatol, to give him credit, has a unbelievably high reputation, stellar reputation in Europe. He frequently advises the ECB. Maybe that's why the ECB is doing the things they're doing, because Anatol believes that we can definitely solve our problems by printing money. One of the really fun things that we get to do as being partnered with GavCal is watch their internal email debates that go on. And there are times that I think that we might have to involve some kind of protection service for Charles and Anatol, the way they go at each other. So really, I actually kind of stay out of that one, but I definitely agree with the Charles Gov view that you can't. I mean, Anatol was actually advocating here recently that you literally give money away to U.S. citizens. Just simply give the money away. Print it and give it. I mean, he's got some very elegant academic data to support that, but it just doesn't make sense. And Warren Buffett's got one of the great sound bites of all time, which is, beware of geeks bearing formulas. And it was the geeks bearing formulas that brought us the disaster back in '08, because they told us that stuff could never happen. I'm very, very suspicious of formulas that work against common sense. And I give Anatol all his credit. He's a brilliant, brilliant guy, but brilliant people are wrong, and I think he's wrong. I just don't think you can print your way to prosperity. In fact, by the way, that's really the topic of tomorrow's Evergreen Virtual Advisor, the EVA. So if this is a topic that you care about, I go into some good detail, try to back up why I think that what's happening right now can only have one outcome in the long run. And it's not the outcome that Anatol believes.
I have two over here.
There's been a lot of discussion about the printing of money, not only in the United States but elsewhere. How would you position or reposition your portfolio going forward to take advantage of this to possibly gain returns? Especially in light of if inflation kicks up, in the next few years, we're going to need actually more return in order to compensate for higher inflation.
Correct. I guess that gets back to the Canadian bond idea, because not all countries are debasing, and as I said earlier, trashing their currency. So I think it's very important, if you're trying to protect against what you just described, to go to countries that have sound monetary policies and have strong fiscal balance sheets. And by the way, it's not just Canada. In fact, that is one of the central themes of tomorrow's Evergreen Virtual Advisor, is the Nordic countries. I mean, they look just like Canada. And what's ironic is if you went back 15, 20 years ago, they were the ones that were all basket cases, and we look good. But because they each had their own crises, and they responded to their crises, not with printing money, but with instituting real, lasting, logical, sweeping reforms. And that's why these so-called cradle-to-grave welfare states are now giving us advice about how we deal with our entitlement disaster, which it is. It is an entitlement disaster. So, I mean, this is a little bit facetious, but I know that, I see some gray hair in the audience, and 40 years ago, some of the guys in here maybe at least thought about going north of the border to escape the draft, maybe just thought about it. Well, now we would strongly suggest you go north of the border to escape the daft, as in daft fiscal and monetary policies that are in place in this country right now. And again, that's not the only safe harbor, but there are, it's kind of, I think it's the most, one we can most identify with because it's so close, especially for us in Seattle.
I think to be specific on the income side, we've identified some things already, such as Canadian bonds or American companies that are issuing bonds in foreign markets. Those are ways to kind of handle it from and then also buying inflation-protected securities. And then on the equity side, I think you look to own companies that can pass through, if you do get into an inflationary environment, the costs. And then commodity-based companies, I think, would fit in that pay a dividend.
For example, Royal Dutch Shell that yields 5%, and it's, if the dollar implodes and oil goes up dramatically just because it's priced in dollars, that's a great way to hedge and still provide some cash flow. Mentioned earlier the floating rate securities. Mary Sue's great at finding. A lot of these are kind of interesting in that they have a fixed rate for a few more years and then they float, which to us is almost like the ideal security because we don't see the inflation threat right away, but we get out later in the decade and that's when we're more concerned. And some of these yield in the 5 to 6 to 7% range. So there are ways to go, but you got to really know what you're doing in this area. And the stock market's tricky enough. When you get in the income world, it's really hazardous.
I'd add one thing. That in Singapore, we're obviously facing exactly the same problems that you guys are here, and this is going to sound like an outright plug, but it absolutely isn't. We've moved towards trying to find real assets that throw off cash flow as a means to mitigate this particular circumstance. The real assets are going to perform well in an inflationary environment. And if you can find them with cash flow revenue streams, and you can, I mean, it's not a stock bond portfolio. It requires a bit of extra diligence. It requires a lot of extra legwork, and it requires at least accepting the fact that you kind of have to think about non-traditional investments. But owning real assets in an inflationary environment that will pay you a stream is a very sensible thing to protect your portfolio.
Why don't we do 2 more, and then we'll give everyone up here 30
I've got one right here. Tyler?
So you were talking about the platinum coin, and I decided that I would mint a $500,000 platinum coin, and I sent it in with my mortgage payment coupon, expecting a refund.
How'd that work out?
Which didn't turn out very well.
Funny thing.
My question is, or a couple questions. Currently read that the Vickers insider buy-sell ratio is about 5.6, where 2 is basically bullish and 2 to 2.5 is neutral, and anything above 2.5 is pretty bearish.
Excellent point. Very true.
Yeah, could you comment on that a little bit, what that portends for the future? And number 2, with China buying gold, Philippines buying gold, Germans now have asked for, I guess, $350 billion worth of their gold out of Fort Knox, and the price of gold going down. What's that all about? I mean, why are these people buying all that gold? I mean, do we see inflation coming back that strongly that they're hedging, basically?
Yeah, firstly, I apologize. I could hear the voice, but I couldn't. This was like one of my bad dreams. I couldn't see where it was coming from. Just want to make sure I addressed the right gentleman. Oh, there. Hi. Sorry. Yeah, look, the Bundesbank gold thing is actually very, very interesting. And it was all started by our friend Hugo Chavez in Venezuela in August of 2011 when he asked for 99 tons of gold back from the Bank of England. And
I could talk for like an hour and a half on this. I'm about to give a presentation in Palm Springs on exactly this subject on Saturday, so I've got all the answers ready.
He actually has a great piece that if you're interested in this topic, we can send it out to you.
Yeah, no,
I'd
be delighted. But the German thing is interesting because the central banks have admitted over the years that they lease out their gold to earn some interest on it. In fact, the Austrian central bank about 2 months ago announced that over the last 10 years, excuse me, they'd made 300 million euros from leasing out some of their gold, which is great. Good luck to the Austrian central bank. And that's a windfall for the Austrian taxpayer. However, the problem comes, that was about 30% of their gold. Now, if you lease this gold out and it goes into the system and off it goes, the bullion banks pay about 34 basis points to borrow gold for 12 months. And they can turn that money around and invest it in Greek bonds and make 9%, which is great. So it's free carry for them. And it's a very, very big trade. And if you do the numbers and you work your way backwards and you assume that this Austrian central bank 30% leasing is standard across the board, which is a fairly sensible amount. If you're going to have 75% of your assets in something that pays you no interest, it makes sense to try and earn a little bit of vig on it. If you do that and you start getting people repatriating their gold, 99 tons for Venezuela, that was followed by Azerbaijan, of all people. Switzerland have got a petition now on the Swiss National Bank's website. 90,000 people have asked to get Swiss gold back from overseas. If they get 100,000, there has to be a referendum on it. You've had, say, Venezuela, Colombia, Mexico. There's plenty of countries now who've all started to kind of say, look, we kind of like our gold back if it's all the same to you. And then Germany throw their hat in the ring. And Germany's a big deal because that's 350 tons from the UK. They're going to bring 300 tons back from France. And the Fed have said that to get that 350 tons of gold back is going to take 7 years. To put that into perspective, if they put it on a plane, and the only impediments you have to shipping that kind of gold is the insurance cost. You can only ship a certain amount of gold. The insurance companies will only insure a certain amount of gold. So instead of 7 years, you could probably, if you did one flight a day, you could probably get that amount of gold back in about 10 days, I would imagine. So the central banks do lease their gold out. They, as Alan Greenspan said, they stand ready to lease it in increasing quantities should the price of gold rise. Well, we've had 12 years of gold going up. So it's a big conspiracy theory and people kind of poo-poo it all the time. But if you look at the numbers, you look at the math, it makes sense that they would lease this gold out. If it has been leased out and we start to get this whole game of musical chairs back, I mean, look, if I'm a central banker and I know that we lease our gold out, I don't want to be the last central banker to ask for my gold back because the last guy to ask for his gold back, he ain't going to get it. So when someone, it's fine when 20 tons here and 50 tons there starts to get chipped away from countries like Azerbaijan, nobody's really listening. But for Germany to come out and ask for that gold back when they did, 2 months after a speech at the New York Fed when they said that the whole concept of wanting their gold back was ridiculous, something is going on in that market, and I suspect it's not going to end too well, but it may take a while to play out.
And his other point was about insider selling. No doubt it's running high. In fact, you were telling me today?
Yeah,
you just saw
it's at 5-year highs.
5-year high. And
we know what happened 5 years ago, right?
Yeah, we know what happened 5 years ago. And if you look at these periodic nasty sell-offs that we've had in the post-Great Recession period, what's really been a good heads up has been intense insider selling. So it just kind of fits within this mosaic of a lot of warning signals all kind of coming together at the same time. So I definitely, as I said in my former presentation, even though we don't think this is going to be a year of a major stock market decline, we think that there's going to still be a fairly intense correction, which, you know, we will try to take advantage of.
And it's probably worth adding that hedge funds are the longest they've been in quite some time in terms of net exposure long to stocks. One more? Last.
Somebody over here was trying to ask.
I'm over here in the cheap seats, Grant. You can see me.
We can see you, though.
Apparently there's a new book out. I've not read it, but it's called What to Expect If No One's Expecting, which has to do with demographics and declining birth rates. And so I guess my question to the panel is, it's a big template, a big umbrella over everything, but how do you input that kind of data as you look at investment decisions as it relates to birth rates, population, majorities, minorities, and whatever?
Well, I'd like to take that one because we actually ran a guest event. I should explain that our format of our newsletter, because even people that get it on a regular basis are probably a little confused. But once a month, we run a guest what I call a guest EVA, one written sometimes by Grant. And I ran one here a couple of weeks ago, or 3 weeks ago, on that very topic. And also, I should say that twice a month we run what we call the Points to Ponder, which, as you've noticed, is kind of more like the front page of the Wall Street Journal, just a bunch of interesting data and then a commentary at the end. So if you've ever wondered why do we kind of get this different sequence, that's why. By the way, we're going to put out an explanatory EVA coming up here soon for new people, but also for existing. It was interesting that when I ran that guest EVA a few weeks ago, I got a couple of negative responses, like critical responses from very bright people that are in the business. And ironically, right after I ran that, the Wall Street Journal had a special article called The Baby Bust. And that created our friends at ISI, triggered our friends at ISI to basically rebut it and say that's not true, that the reason demographics are bad in the US right now, comparatively speaking, is because of the recession. You know, when people can't, well, actually we're supposedly in a recovery. It's another thing that doesn't really quite add up because it isn't getting better yet. But it does make some sense that when you go through economic hard times, people don't get married and have kids like they would normally. But I think that's kind of missing the point, because as we said in that particular EVA, when you compare the US versus Japan or Europe, we look great. We almost look like an emerging market. And well, I'll tell you, a country that's really going to have trouble in a few years is China, because of the impact of their one-child policy. So relatively speaking, we look pretty good, but you know, the reality is the world is so intertwined. I don't think it does us good to sit back and say, hey, you know, we've actually got a pretty good demographic trend compared to the rest of the world if the rest of the world starts to, you know, really have problems. Because, you know, as I pointed out in that issue, the welfare states in the modern world, the Western world, are built on the idea that you've got a lot more young people than you do old people. It's the pyramid. And when that pyramid begins inverting, you've really got problems. And we're not facing up to those problems. Where it's really going to come to a head much sooner in the US, so we'll get a sneak preview of how this all plays out, is Japan. Because Japan, we talked about this today in the research meeting, Japan is actually selling more adult diapers than baby diapers now. And what was your little comment about that?
Yeah, I mean, Japan, the Japan demographic chart is horrible. There's 21,000 people every month net dying in Japan right now. So there's a small village being wiped off the map in Japan every month. And the best stat I read about this, there's a public holiday in May every year in Japan called Children's Day. And someone did the numbers and worked out that at this rate of population decline, in May 3011, there'll be one child left in Japan to celebrate Children's Day. So.
And you know, the problem that China and Japan both have, they don't have immigration. One of the things the United States has is a huge advantage, if we could figure out how to use it properly, is this natural immigration. Now, what's interesting is if you look at the flow of Mexican immigrants in the United States, for the first time ever, at least since I think the Great Depression, it stopped because their economy's better than ours. I think pretty soon we're going to have Californians sneaking across the border into Tijuana. Which, given the tax structure in California, I wouldn't blame them. Phil Mickelson might want to do that. You know, Cabo's a nice place. So, but I guess the closing thing I would say, demographics move very slowly. So I think that the impact on the stock market overall, you know, it's not a good time fit. But I think it's a very important trend to be aware of, and it just is another one of these things where you look at the trends in the United States right now, and they just don't make sense. There's just got to be this, you know, our view is until we have the next crisis, our politicians aren't going to do anything. I'm taking you right to the close of tomorrow's EVA. But that's really it. We think there's another crisis, and then, looking optimistically, then we think we'll follow the Swedish model, the Canadian model. I mean, you can go on and on. There's so many countries that have been in worse shape than we are now, but they've done the right thing. The problem is the Fed is allowing these idiots to continue with the current policies. And that is one of the biggest tragedies of what the Fed is doing right now.
I think in terms of investing along demographic lines, it's very difficult because investors don't have long enough time horizons for you to use that as an overlay in your investment decision. We have to take it into account. But if you talk to an investor and you explain to them, well, this is in your portfolio because in 25 years the population is going to be declining at X%, it's a very difficult thing to quantify and explain to people.
I guess kind of to my closing remarks would be that we've talked a lot about the kind of uh-oh events coming in the next couple of years, few years. It's hard to say when. But I think that what Dave just said is probably extremely important to hear, and that's, we think that after we go through that crisis, it'll be the birth of the next American bull market, because there are good things going on here. I mean, we've talked a lot about the negative, but you know, to be energy independent would be extremely advantageous. I think the idea that 49 of the top 100 universities in the country are
in the world
are located in this country is extremely bullish. I think that the fact that we're still perceived as the reserve currency, let's hope that remains, is a huge positive. And I think that the idea, people ask me all the time, you know, when is the gig over for the U.S. being the dominant superpower economy? And I think that to the point of immigration, it's when either we don't let the people that are graduating from our universities in math and science and all the innovative industries stay here, and we send them home, we educate them, then we ship them home. I mean, come on, that's not very commonsensical, but it seems like that. And then there's been some, by the way, there's been some productive dialogue in Washington on figuring out ways to keep those people. But the answer to the question was, it's really, the gig is up when smart people from foreign countries who become educated and they decide that they're going to start a new business, and they think, what country in the world do I want to start that business in? When they don't say the United States anymore, that's when you should be worried, and we don't think we're anywhere near that point.
And I would just reiterate what he's saying. The U.S. continues to be the innovation leader, and that's a huge advantage compared to France, where I don't think there's been a single new company that's joined their S&P 500 in like 30 years. And you look
can't try and wrap this up and then start talking about France.
I know. France, we could go on and on for a long time about France. We don't want to do that. You guys have been fabulous. Should we wrap it up now? And if people
can I just say thanks to the guys, to Tyler, to Jeff, to David for having me here. It's a real treat for me to be here. I mean, these guys are just lovely people, very smart, and they know what they're doing, and I'm very privileged to be here, so thank you.
And I would say if you're not reading his newsletter, you're really missing out. It's probably the finest newsletter, second finest.
No, I nominate him. He's better.
Thanks, Grant, for coming.
And it's free. Thank you, everybody.